all the previous example have got a profit in the associate, but actually there can be losses in associate. So we share the profit of the associate, and therefore we have to share the loss of the associate as well. When we share the profit of the associate, we debit the investment in associate, and we credit share of profit of associate when we share the profit. If we share the loss of the associate, just the opposite, we need to debit share of loss of associate and credit investment in associate. But we cannot credit investment in associate forever if the loss is so bad, so that when we credit the investment in associate, the worst case is the investment in associate accumulated in our consolidated balance sheet should only be 0. So that's why we cannot credit the investment in associate forever. We can only credit it up to 0. Take an example. In this case, we have got a 40% associate investment. So 40% associate. The original cost was 500,000. So that's why on the day of acquisition of this associate, we must have debited the investment in associate 500,000. 500,000 is the original balance of this investment in associate. In the year end, we have got a profit after tax 100,000. So we share this profit. When we share profit, we debit investment in associate and credit share of profit of associate. We can share 40% of this 100,000, and therefore we debit investment in associate 40,000, and our investment balance becomes 540. Originally, it was 500 plus 40,000 that we share during the current year. This would be 540,000 investment in associate. In year 2013, we got a big loss, 1 million loss. We have to share this loss as well. 40% of this 1 million means 400,000. Why 400,000? So we need to debit share of loss of associate 400,000, and we credit investment in associate 400,000. Therefore, our investment in associate becomes 140 because we have to credit investment in associate 400,000. So this becomes 140. In 2014, we continue to have a loss, so we need to credit investment in associate 40% of the 500,000. 40% of the 500,000 is 200,000, but 200,000 is too big. Why? Because the investment in associate is only 140. If you credit 200, it will become a negative figure, so we cannot do so. So the maximum amount that we can credit away is only 140. So we debit share of profit, share of loss of associate 140, and we credit investment in associate 140. If that is the case, we still have 60,000 loss we haven't recognized because the investment in associate is already 0. It should not be a credit because there's no liability. So worst case of my investment should be 0 only because I don't guarantee anything. Right? So there is no liability. Worst case of an investment is only 0. Thereafter, we have a profit. Profit is 100,000, so we can share 40%. 40% of the 100,000 is only 40,000, which is not enough to make up any negative 60,000. Right? So that's why still we cannot share any profits in year 2015. But we understand that the loss that we have not recognized is only 20,000. So basically in 2015, there's no accounting entry, but we keep it in record that the loss that we have not recognized is only 20,000. 2016, we have got a profit of 500,000. So for this 500,000, we share 40%. So 40% of the 500,000 is 200,000. So we can share profit, right? Because it is more than the negative 20. Because negative 20 we haven't recognized yet. So now we can recognize 180. So that's why we debit investment in associate 180,000, and we credit share of profit of associate 180,000, and therefore we have got our 180,000 as our closing balance for the investment in associate. After we know the profit and loss, there should be some disclosure requirements, right? So we know how to equity account for the associate, we know how to consolidate a subsidiary, then there will be some disclosure requirements. Disclosure of involvement with other entities will be governed under Hong Kong Financial Reporting Standard 12, right? So if we have to talk about the annual reports in relating to the subsidiary, investment in associate, investment in joint venture, etc., we have to go through this Financial Reporting Standard 12. So we will not go through in very detail for this course, because basically we mainly focus on the calculation part, right? So disclosure is important when you have to prepare an annual report in the consolidated financial statements. So in this Financial Reporting Standard 12, we understand that we have to disclose something like the significant judgment and assumption used in determining whether we have got control, joint control, and significant influence. If you have any investment in subsidiary, you have to disclose about the investment in subsidiary. If you do have some partially owned subsidiary, you have to disclose the details about the non-controlling interest, right? How you measure non-controlling interest, etc. And then you have to disclose also your investment in joint arrangement and the investment in associate in details. There's something more about the disclosure, right? So sometimes we understand that we need to understand the risks about a company. For consolidations, we aggregate everything together. We know that when we aggregate everything together, we lose the details. Right? Consolidation is important because we want to have a summary of everything within a group. But once we sum up everything, once we aggregate everything, we lose the details. Therefore, the other way around, we need to know the detail. And therefore, we require further disclosure. So we understand that we need to tell the financial statement users something about the risks involved in our company, in our consolidated group, and therefore we report about the risk. We report about the risk. So there are many reasons that we have to report about the risk, because if we report about the risk, this helps the investors to make decisions. We understand that the higher the risk, the higher may be the expected return. If we disclose the level of the risk to the investors can make judgment whether they want to invest in this company or not. And also, if we disclose about the risk, this tells financial statement users more information. So therefore, the financial statement users, the investors, may understand how is the risk of this company, and then they can decide what is the cost of capital expected. And also, if we disclose more, of course, this builds up a level playing field. So because not all investors are equally informed, so if we disclose more, we reduce the information asymmetry, and therefore it will be more attractive for the investors to invest. And also, if we disclose the risk, this enhances the management accountability. If we do not disclose, we never try to find out how is the level of the risk for a particular entity. If we report it, of course, we try to measure the level of the risk, then the management will know how is the risk, and this helps to protect the investors as well. And of course, when we know the information about the risk, we know which area we got particular higher risk, we know which area we can better protect. So therefore, this will enhance the risk management. All these are the reasons why we have to report about the risk. There are many different methods to report about the risk. There will be some summary metrics like the credit rating, the value and risk, sensitivity analysis, and there may be even bankruptcy prediction model, something like the SAT score or something like that. There will be descriptive information in our annual report. We surely understand that we report many things. Right? As I've said before, if we disclose more, the financial statement users will know more, and therefore they can assess, they can evaluate the risk themselves. there has been discretionary disclosure. Say, for example, in the annual report, many pages are involved in the management discussions and analysis. So the management will tell us their view of the business and any analysis that they want to provide with the financial statement users. And there will be other regulatory disclosure, while some particular industry may have to disclose more. So these are all descriptive. And then there will be many accounting-based information as well. Specifically, there will be segment reporting. As I've said before, for consolidation, we sum up everything, we aggregate everything, reduce the detail. So the other way around, we want to report on each individual segment so we know the information in more detail. So therefore, we have the segment reporting. And there will be risk related to the financial instruments. Therefore, we have got a particular financial reporting standard number 7 on financial instruments disclosure. We disclose a not under the financial reporting standard number 7 for financial instruments. We disclose also about the contingency, right? So we always disclose about the contingent liability, and then there will be related party transactions as well. So we'll talk about this. Now, the first thing is, we'll talk about the operating segments, segment reporting. Operating segment is governed under financial reporting number 8. Related party disclosure is governed under Hong Kong Accounting Standard number 24. We have got Hong Kong Accounting Standard number 37 on the provision, contingent liability, and contingent asset. And also we have got the financial reporting number 7 on the financial instruments disclosure. So these are the accounting standards involved in the disclosure of the risks of a company. First, we talk about the financial reporting number 8, which is on operating segment. So basically, this financial reporting number 8 applies to enterprise whose debt or equity securities are traded in a public market. So usually we call this a listed company. So it can be a public market or an over-the-counter market, or are in the process of issuing in the public security market. That means they are under the IPO process. So will be a listed company or is already a listed company. So if a financial reports contain both the consolidated financial statements as well as the parent's own separate financial statements, then the segment information is required only in the consolidated financial statements. If we report both consolidated financial statement and the separate financial statements, then this operating segment information is required only in the consolidated financial statements. Under this financial reporting standard number 8, we require the identification of the operating segment. We have to disclose the operating segment. How to identify the operating segment? We'll use the internal report regularly reviewed by the enterprise or entity's chief operating decision makers in order to determine the operating segment. So we will use the internal report. In the big company, the chief operating decision makers will require some information about their business. So each segment, each business unit may report to this chief operating decision maker. So that's why we know how they will report, and then we'll use this internal report, which is regularly reviewed by these chief operating decision makers in order to determine the operating segment. So sometimes we may identify many operating segments, and we may have to aggregate this operating segment if they demonstrate similar economic characteristics. And also this financial reporting number 8 give us some quantitative criteria to determine the so-called reportable segments. Not all operating segments are reportable, right? Otherwise we may have 100 operating segments to report, which is no good for financial reporting, too much, right? Therefore, we have to identify first the operating segment. So what is an operating segment? Operating segment is a component of the entity that engage in the business activities from which it may earn revenues and incur expenses. It generates revenue, it incurs expenses. Also, the operating segment should be a component of the entity whose operating results are regularly reviewed by the entity's chief operating decision makers. And also, the operating segment should be a component of the entity for which discrete financial information is available. You must have got the financial information about this component of the entity, otherwise nothing for you to report. So we fulfill all this, then this may be an operating segment. Once we have identified the operating segments, then we have to determine whether this operating segment is reportable. We have to report it. The financial reporting number 8 said, once identifies the operating segments needs to be reported only if it meets any one of these quantitative thresholds. Only any one. Either it fulfills the revenue test, or profit or loss test, or the asset test. Revenue test means the revenue of the operating segments, including inter-segment sales. Even if this is an intra-group transaction, we still regard it as a sales revenue. If the revenue is 10% or more of the combined revenue, if it accounts for 10% of the combined revenue, then it is reportable. Second, profit or loss test. If it is 10% or more of the greater of in absolute terms, so if it is a profit, then the combined reporting profit of all operating segments that did not report a loss. So we count only those segments which have got a profit, we add them together. This is a combined reporting profit. If the profit of this entity is 10% of this combined reporting profit, then it is reportable. Or if it is 10% of the combined reported losses of all operating segments that report a loss. So we add all the loss generating segments together, and then we got the combined reported loss. Right? We don't know which one is bigger. If many segments are profitable, then the combined reporting profit will be bigger. If many operating segments are loss making, maybe the combined reported loss is bigger, then we got the bigger one. Right? The bigger in absolute terms. And then if the profit or loss of this segment is 10% or more of this combined reported profit or combined reported loss in absolute terms, then this is reportable. The third one, asset test. If the asset of the operating segments are 10% or more of the combined assets of all operating segments, we add together all the assets of all the operating segments. If the segment of this operating segment is 10% or more, then this is reportable. So higher, bigger means they will be reportable, but any one, not necessary to fulfill all. Either one, then this is reportable. So if we find that some of the operating segments, they may not be big enough, then operating segments that exhibit similar economic characteristics may be aggregated together, right? So if they are similar, we may aggregate together so that it will become a significant one and it may be reportable. However, financial reporting number 8 permits management to report an operating segment that does not meet any of the quantitative threshold if management believes that information about the segment would be useful to users of the financial statements. So if we think that it is useful, the management may use its judgment, may use its discretion to report it as a reportable segment. This management override also extends to segments that were identified as reportable segment in the preceding period. So last year it is reportable. Now we think that continue it is significant. So even though it does not meet the quantitative criteria, because we think that it is still significant, the management again can use the discretion to report it as a reportable segment. So we identify some reportable segments. Say for example, originally you have got 10 operating segments, and out of which we find that 6 of them are reportable. There is one more criteria. If the total external revenue reported by the operating segment constitute less than 75% of the entity's revenue, right? If you add together these 6 reportable segments, you find that the total revenue is less than 75% of the entity's revenue, then you have to identify more segments as additional reporting segments. So additional reporting segments must be identified as reportable segments, right? Even though they do not meet the quantitative threshold, but we must make up 75%. So you may have to identify 1 or 2 more operating segments as reportable, so that the total of these reportable segments must be at least 75% of the total revenue. So there may be a practical limit. Financial reporting number 8 recognizes that there will not be any precise limits to be determined on the number of reportable segments, but they suggest that in practice, they will have a practical limit of 10. If you have got too many reportable segments, impossible, right? Because the criteria is 10% each. So if you have got 10 operating segments, strictly speaking, you should be able to have a 100% of the total already, right? So there's a practical limit of 10, even though there's no precise limit determined by the financial reporting number 8. Once you have got an operating segment, then of course you have to report and disclose. First, you have to disclose the factors that determines the identification of the reportable segment, how you determine these reportable segments. Second, for each reportable segment, you have to disclose the segment profit or loss, and you have to disclose the detailed disclosure on the revenue and expenses of each reportable segment. So profit, loss, revenue, expense. And also you have to report the segment's asset. Each reportable segment, you disclose the asset and also the liability of each operating segment, each reportable segment. You have to disclose also the basis of the measurement. And lastly, you have to add together the segment's revenue, segment's profit or loss, segment's asset, segment's liability, and any other significant items. You have to reconcile it with your consolidated amount, right? Because the total of your segment result may not be the same as your consolidated financial statements. So you have to reconcile so that financial statement users know how to match the segment's result with the consolidated result, because there will be some intra-group transaction, etc., that you have eliminated on consolidation. So you have to reconcile everything. This is for financial reporting number 8, operating segment. After financial reporting number 8, we have another accounting standard which is related to the risk reporting, which is the accounting standard number 24 on related party disclosure. Related party disclosure. We understand that on consolidation, there will be many intra-group transaction or some transaction which may not be so direct, right? So therefore, we want to know whether those transactions, whether those related party transactions are really important or so. So therefore, the related party disclosure have got an overriding principle. An entity's financial statements should contain disclosure to highlight the existence of related party and transactions. So we have to highlight if there's any existence of related party, if there's any related party transactions. And also we have to highlight any outstanding balance with such related parties. So what is related parties? Related parties can include many things. The persons of control demonstrate related party. Parent subsidiaries, they are related party. The persons of significant influence, investors, associates are related parties. Joint control, right? Joint venture with their joint venture are related party. The position as a key management personnel, if you are director of a company, you are related party. Party in a post-employment benefit plan. So if this is a entity for the post-employment benefit plan of a related party, then this is a related party. Close family member of key management, they are also related party. So many. So this is the true definition of a related party. So what is a related party? A related party is a person or entity that is related to the entity that is preparing its financial statements. So the party, the entity that is preparing the financial statement is the reporting entity. So now we are determining the related party of this reporting entity. Related party can be a person. Related party can be an entity. So the related party can be a person. That person or the close member of that person's family will be a related party if that person have got control. If I control an entity, I'm a related party. If I've got joint control over the reporting entity, I'm also a related party. If I've got significant influence over the reporting entity, I am a related party. If I'm a member of the key management personnel of the reporting entity, if I'm a director of that entity, I am a related party. If I'm a member of the key management personnel of the parent of that related party, right? So if I'm a director of the parent of that reporting entity, I am a related party. Not only a person can be a related party can be also an entity. So an entity is related to a reporting party, to a reporting entity if any of the following conditions applies. So entity can be a related party if the entity and the reporting entities are members of the same group, right? So if we are fellow subsidiary, if I'm the parent, right, and the subsidiary, so parent, subsidiary, related party, subsidiary parent, related party, fellow subsidiaries, related party, if they are within the same group. So that's why in the consolidated financial statements, parent, subsidiary, and fellow subsidiary, they are all related parties. If one entity is an associate or joint venture of the other entity, or is an associate or joint venture of a member of group of which the other entity is a member, then they are related party. So if I'm an associate of the other part entity, if I'm the joint venture of the other entity, then we are related party. If both entities are joint venture of the same third party, so if we are fellow joint venture, we are related party to each other. If one entity is a joint venture and the other entity is the associate, so one joint venture, one associate, we are related party to each other. If the entity is a post-employment defined benefit plan for the benefits of the employee of either the reporting entity or the entity related to the reporting entity, right, then we are related party. If the entity is controlled or jointly controlled by a person identified in A, so I'm a person and then I have got a control of one party A and entity B, so entity A and entity B is related party, right? They are fellow subsidiary or fellow joint venture under a person, right? Under a person but not under an entity, still they are related party. A person identified in A1, right, have got a significant influence over the entity or is a member of the key management personnel of the entity. So now we are not under an entity, we are under a person. So the person have got significant influence, so we are significant fellow associate under a person, then we are related party. The entity or any member of the group of which it is a part provides key management personnel services to the reporting entity or to the parent of the reporting entity. So if the entity provide some key management personnel services, they provide director service, right, then they are related parties. Anyway, we got many definitions of related party. So once we have got a related party, we have to make related party disclosure. Remember, we said not only that person, right? If this is a person, not only that person, it includes also a close member of that person's family. They are also related party. So Hong Kong AS 24 defines close family members as those who may be expected to influence or be influenced by that related party. So close family members may include the related party's domestic partner, maybe the wife or husband, and children. Children are also close family members. Also, close family members include the children of the related party's domestic partner, right? So the children of your domestic partner may not be your own children, but it will be included as a close family member. Dependent of the related party or the related party's domestic partner will also be close family member, right? So the dependent of the related party may not be your own dependent, but it may be also a close family member. Right? So related party does not include only yourself, right? If you are a key management personnel of a company, of course you are related party, but your wife, your children are also related parties. The whole family members are related parties of an entity, of the reporting entity. Key management personnel refer to those individuals who have the authority and responsibility to directly or indirectly to plan, direct, and control the activities. So if you can control, to plan, and to direct the activity of the entity, you are key management personnel. So basically, if you are a director, you are key management personnel. Once you have identified the related party, then there may be related party transaction. So related party transaction is defined as the transfer of resources, services, obligations between a reporting entity and the related party. So even if you did not charge a price, still this is a related party transaction. If there has been a related party transaction, once it exists, information is required to understand the potential effects of the relationship on the financial statements. All this must be disclosed. So we have to disclose about the related party, right? So you have to disclose on the related party relationship. Even if there's no transaction, still you have to disclose about the related party relationship, even if there's no transaction. Why we have to disclose about the related party? Because we want to know whether your transaction has been made at an arm's length transaction or not. So if you have got transaction, then you have to disclose about the nature of the related party relationship, the amount of the transactions, the outstanding balances, the relationship between the parent and the subsidiary, and the name of the entity's parents and the ultimate controlling parties. You need to report also the compensation of the key management personnel. So that's why in the annual report, you'll find the salary for the directors, the remunerations to the directors, right? Because we need to disclose about the compensation of the key management personnel, because key management personnel, they are related parties. We want to know whether your transactions has been made in the arm's length terms or not. So what is arm's length? An arm's length transaction refers to a business deal in which buyers and sellers act independently without one party influencing the others. We understand that in a related party transaction, very often we may be under the influence, under the significant influence. If this is the case, the terms may not be real terms, right? They may collude each other. Therefore, we want to know. So if we have disclosed this related party relationship, if we have reported this related party transaction, it's try to build up the confidence of the financial statement users that the transaction should be arm's length. So both parties act in their own self-interest and are not subject to pressure from each other party, then this is arm's length. So we are not subject to the pressure. It's arm's length. At least we got some distance, the arm's length distance, right? So it assures others that there's no collusion between the buyer and seller. So we want to ensure that this is an arm's length transaction. There's no collusion. This is the reason why we have to report on the related party disclosure. There should be separate disclosure required for the parent entity with joint control or significant influence over the entity. So if you got a parent report, joint control report, significant influence report. So we have to report for the subsidiaries, associates, joint venture, key management personnel, and other related parties, and the provisions of the key management personnel services. For each type of related party, you have got a separate disclosure. There's one exemption. An entity is exempted from disclosure of transaction with a related party that is a government. So you understand that, say for example in China, government is a related party to many entities in China. So if we have to report all the related party transactions, all the related parties that is involved with a government, then you got thousands and millions of disclosure. So therefore, we are exempted if this related party is related to the government that has got a joint control or significant influence over the entity, or another entity that is under the joint control or significant influence of the same government. Then if we are fellow state-owned enterprise, we don't disclose each other. Otherwise, you got too many related parties that is related to the government. However, by applying this exemption, entity is required to disclose the following. First, we have to disclose the name of the government. So for all those state-owned enterprise, we just disclose Chinese government and the nature of the relationship with each other. Why we are just all belonging to the government, Chinese government, because we are state-owned enterprise. And we have to disclose the nature and amount of each individual significant transaction. Any qualitative or quantitative information should be disclosed on collectively significant transaction. This is for related party disclosure, Hong Kong AS 24. The third accounting standard is accounting standard number 37, provisions, contingent liability, and contingent assets. Under these accounting standards, we'll provide some information which try to alert the users to the possibility of a loss occurring in some periods as a result of some past events. There may be contingency. Contingency are because of the lack of reliable estimates of the future losses. So we don't have a reliable estimate of the future loss, and this is the reason why we call it a contingency. But this future loss has to be assessed as to its likelihood of occurrence. So therefore, we provide information about this contingent liability. If it is probable, of course, we will make the provisions, or if it is very probable, it may already be a liability. But in addition to the provisions and liability that we have provided, we need to disclose about some possible but not probable contingency. And therefore, we disclose the contingency in our disclosure notes. And this gives financial statement users more information to assess, to evaluate the risk of a company, whether there may be a future loss. Last accounting standards related will be the financial reporting number 7, which is on financial instruments disclosure. If we have to prepare our annual report, very often we have to refer to this financial reporting number 7, which governs all the disclosure of the financial instruments. In this financial reporting number 7, it requires the disclosure of the financial risk exposure based on the internal management information. There may be some specific risks related to the financial instruments. So therefore, you have to disclose some qualitative information as well as the quantitative information related to the financial instruments. And then there may be some risk management policy. You have to disclose how you try to manage the risks relating to the financial instruments. And you may have some hedging activities, then you have to disclose about how you hedge, right? So the summary about the exposure, etc., we have to disclose in this financial instruments disclosure requirements. Of course, in the examination, I will not ask you to disclose all the details, right? But at least you should have some understanding about the financial reporting standard number 7, accounting standard number 37, accounting standard number 24 on related party disclosure, and the financial reporting number 8, operating segment. Just a brief understanding on the requirement, which will be enough for this subject.